Welcome, dear traders, it's me, Kate Stichin, and you're watching a recap of the Asian session. On Wednesday morning, a sell-off on Wall Street continued. Australian equities declined significantly. Even the Japanese benchmark stock index slid from a 30-year high. In the morning trading, speculators decided to lock in profits amid uncertainty over the Fed's rate decision, the debt ceiling deal, and worsening relations between the United States and China, and now they are sitting on the sidelines. Perhaps they will get more clues about the Fed's future plans for monetary policy from the May meeting minutes, which are due today. However, market participants are more focused now on the negotiations between the Biden administration and Republicans. The current talks look more like a rehearsal for the presidential race. Nobody wants to make concessions. However, the lack of significant progress in the negotiations does not prevent both sides from making optimistic comments about them. We reiterated once again that default is off the table, and the only way to move forward is in a good faith toward a bipartisan agreement, Biden said. The debt ceiling is a limit that Congress imposes on the amount that the government can borrow. This is why it's rather risky to prolongate the talks until the ex-state. Treasury Secretary Janet Yellen believes that it will cause severe damage to the business sector and undermine Washington's ability to provide international leadership and defend U.S. national security. The ex-state is now June 1st. Within a week, the U.S. Treasury will be unable to pay all of its bills. However, investors are casting doubts that this scenario could take place, and the yield of U.S. Treasury notes is still rising, but at a moderate pace. The US dollar again ground amid growing Treasury yields. It also rose following hawkish comments of Fed policymakers and unexpectedly strong data on the PMI indexes and in new home sales. Fresh economic reports signaled the likelihood of a further monetary tightening. In the morning, the greenback climbed 203.50 versus its main rivals. However, later it was rather volatile. It was moving in the narrow range of 103.30 and 103.50. However, it retained a bullish bias. Usually, demand for the US dollar as a safe haven asset rises amid market uncertainty. If the US becomes the reason for market chaos, it may have a negative impact on the US dollar as well as intermarket correlations. The yen took advantage of green prospects for the US dollar. In the Asian session, the yen made several attempts to advance against the greenback in the price range of 138.20 and 138.70. However, market sentiment can change rather quickly. For example, this morning, the pound sterling tipped the balance of power between the yen and the US dollar after the publication of reports on unexpectedly high inflation in the UK. The pound sterling jumped, becoming one of the strongest currencies in the basket. The yen was unable to pick up a trajectory, fluctuating at 138.50. As for the Australian dollar, it was steadily moving in the bearish channel over 0.6567 and 0.6622. According to fresh macro stats, the Australian economy has begun to slow down, and this is why the Reserve Bank of Australia could take a pause in the tightening cycle. The Aussie mainly reacted to external factors in the Asian session. Risk aversion in the stock markets and the strong US dollar are the main bearish factors for the Aussie. It tested the April low of 0.6575 and it could drop to the March low of 0.6565. The Australian currency even ignored rising oil prices, which jumped to 3-week highs. However, the Aussie may recover as the US dollar index may tumble due to the default fears. The New Zealand dollar also made an attempt to rebound. The Kiwi dollar pair was trading near the upper border of the range of 0.6131 and 0.6258 amid a weak bullish sentiment. However, the Kiwi failed to resume steady growth. It fell sharply to 0.6137 after the Reserve Bank of New Zealand's rate decision. Its trajectory did not change because of the size of the rate increase by a quarter point. It was in line with the forecasts. The regulator has already raised the interest rate 12 times, bringing it to the highest level since December 2008. As follows from the comments, the central bank decided to take a pause, and the official cash rate reached its highest level. It will be on hold at the current level of 2023, and the regulator could cut the rate in the third quarter of 2024. Almost 72% of investors expect the Fed to keep the key rate unchanged at its June meeting. However, the negotiations on the debt ceiling overshadowed expectations of the Fed's rate decision. One should remember that it's possible to make a profit even in a highly volatile markets. To do so, you need to have the latest market news at your fingertips. Watch our video reviews and keep close tabs on the market developments with us. See you soon!